In this video, we are going to connect the most important ICT strategies into one complete smart money concepts roadmap. Turtle Soup, Silver Bullet, Cameron's Model, OTE, CRT, CISD, Power of Three, and the Unicorn Model are not random setups. They are different pieces of the same liquidity concept in trading, showing how price moves from liquidity to manipulation to confirmation and finally to execution. This is not just another support and resistance trading strategy. We are going beyond basic levels and breaking down how professional traders trade using price action trading strategies. Liquidity sweeps, inducement, higher time frame trading strategy, fair value gaps, and supply and demand zones. By the end, you will understand how to connect these ICT models into a clearer process for more structured and consistent trading decisions. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Before we break down each ICT strategy, we need to start with the framework behind many of them, the power of three. This concept explains how price often moves from consolidation to manipulation and then into continuation. That is why it is the best place to begin. But first, there is an important clarification we need to make about the power of three, also known as AMD, especially when we relate it to proper Wyckoff methodology. The power of three was popularized by ICT, and the accumulation, manipulation, and distribution naming was simplified to make the concept easier to understand. Here at ComLucro, we are students of Wyckoff methodology, and we even have dedicated content and a full course on this subject on the channel, so we prefer to use the correct Wyckoff nomenclature. The strategy itself does not change at all, only the terminology used to describe the phases. It is important to understand that during a consolidation, you never know in real time whether it will result in accumulation or distribution. A consolidation only reveals its true nature after the next phase unfolds. Because of that, labeling a range too early as accumulation or distribution can be misleading. The correct way to think about it is that consolidation is neutral until the market shows its intention through continuation or reversal. What changes is the probability based on context. In a bullish environment, consolidations tend to act as accumulation or reaccumulation before continuation higher. In a bearish environment, consolidations tend to function as distribution before continuation lower. This mindset keeps your expectations aligned with market structure, avoids rigid labeling, and allows you to apply the power of three with clarity, flexibility, and proper Wyckoff logic. The power of three is a trading pattern that breaks down price action on the chart into three major phases: consolidation, manipulation, and continuation. The first phase is a consolidation, which can later prove to be either accumulation or distribution, depending on what happens next. During this phase, price lacks a clear directional trend and often forms equal highs and equal lows, building liquidity and stop losses above and below the range, depending on the time frame. This consolidation can appear in different structures, and on higher time frames, it usually forms a well-defined range. The manipulation phase occurs when price moves away from the consolidation through what appears to be a breakout, but fails to follow through. In basic price action, when price breaks below a support level, that level often becomes resistance and pushes price lower due to trader behavior. Traders who previously went long see the retest as an opportunity to exit, while others see it as a chance to enter short. However, when price fails to continue and quickly returns back inside the consolidation range, this movement is classified as a fakeout. This action is designed to sweep liquidity outside the range and trap breakout traders. Once liquidity has been collected, price typically expands in the opposite direction. This final phase is what we refer to as continuation, and it is where trade execution takes place. As traders applying smart money concepts, the objective is to enter after liquidity has been taken and stops have been triggered. In simple terms, the Power of Three framework describes a sequence of consolidation, manipulation, and continuation, with accumulation or distribution only becoming clear after the continuation phase unfolds. Similarly, in a bearish scenario, the market forms a consolidation followed by a breakout to the upside, which engages liquidity above the equal highs. If price quickly returns back inside the range, this signals a fakeout, and the Power of Three pattern completes with a sharp continuation move to the downside. So, how do we enter a trade using the Power of Three pattern? We aim to enter trades after the manipulation phase is confirmed. First, price must return back inside the consolidation range, confirming the failed breakout. We then mark the candle closes that define the consolidation area. For entry confirmation, we need a clear break and close back inside the box. The stop loss is placed above the swing high, while targets are set at key levels ahead of price. There are situations where price expands aggressively and the initial move is missed. When that happens, we wait for a new market structure to form, and then look for a pullback to enter at a better price with a balanced risk-to-reward ratio. In other words, we focus on continuation trades after manipulation, aligning with the dominant direction rather than chasing price. If we look at this price formation from an intraday perspective, the daily candlestick would reflect this behavior clearly. Price opens, forms a high, moves to a low, and then closes strong. The objective is to capture the largest directional move within the intraday range, using the Power of Three framework. Now let us move to the chart and review some real trading examples. It is important to remember that this setup is not limited to a single time frame and works across both lower and higher time frames. In this example, we are analyzing gold on the 30-minute chart. The market is forming a clear consolidation range with repeated rejections from both the top and the bottom, signaling liquidity being built above and below the range, which can later resolve as either accumulation or distribution, depending on continuation. If we are bullish, the idea is to wait for manipulation below the consolidation lows to engage sell-side liquidity, and then expect price to continue higher. If we are bearish, we look for manipulation above the equal highs to engage buy-side liquidity, and then anticipate price continuing lower. In both cases, the consolidation itself remains neutral until the continuation confirms direction. Let us see how this plays out. Here, the next two candles break above the equal highs, engaging buy-side liquidity and trapping breakout traders who believe the level had been broken. When price returns back inside the consolidation range, the manipulation phase is confirmed. From this point forward, we look for a short entry aligned with the expected continuation. In this example, we have a clear opportunity to open a short position at the close of this candle, expecting price to push lower. The stop loss is placed above the swing high and the target is set at 2 times the risk. As price expands lower, the Power of Three sequence completes with a strong continuation move to the downside. It is important to understand that, like any trading concept, the Power of Three should not be used in isolation. It becomes far more effective when combined with other smart money concepts. For instance, if a higher time frame supply zone were present at this level, it would add strong confluence to the setup, increasing the probability of rejection. The same applies to higher time frame trend context. If price is already in a clear downtrend on the higher time frame, this short setup gains additional confirmation by aligning with overall market direction. This is why combining multiple concepts leads to more structured, consistent, and informed trading decisions. Now that we understand the broader logic of consolidation, manipulation, and continuation through the Power of Three, we can move into a strategy that focuses more directly on the liquidity suite itself, the ICT turtle soup. Here at ComLucro, we have refined the ICT Turtle Soup framework into two liquidity models based on the type of liquidity being targeted by the market. The first model focuses on internal liquidity sweeps, where price temporarily sweeps short-term liquidity within a broader range before the main trend resumes. This variation is commonly used as a continuation setup. The second model focuses on external liquidity sweeps, where price attacks a major range extreme, takes external liquidity, and then fails to continue beyond that level. This variation is commonly used as a reversal setup back into the range. The key distinction between these two frameworks is understanding whether the market is targeting internal or external liquidity. Now, let us explain the ICT Turtle Soup setup within the context of an internal liquidity sweep in a bullish scenario. This setup appears when the market is already trending in one direction. Instead of reversing the entire range, price forms a temporary pullback, sweeps internal sell-side liquidity during that retracement, creates a fake change of character or fake market structure shift, and then resumes the main bullish trend. In this context, the Turtle Soup setup becomes a continuation entry rather than a full reversal, as shown in the chart example. Here, we are not looking for a random liquidity sweep. We are looking for a turtle soup condition forming within an internal range liquidity sweep context. This means price is still trading inside a broader range structure, but temporarily trades below an important internal low before reclaiming the range. The key idea is that the sweep itself is not the entry signal. The sweep only confirms that liquidity resting below the lows has been taken. What matters next is whether price fails to continue lower after the sweep and starts showing signs of bullish reversal on the lower time frame, creating a bullish lower time frame change of character or market structure shift. After that, within our framework, we apply a Fibonacci retracement to the impulsive move and place a buy order at the 50% retracement level. The stop loss is placed below the structure low, while the targets are divided into two levels. The first target is positioned at a 1-to-1 risk-to-reward ratio, and the second target aims for the most recent higher high on the higher time frame. The same logic applies to the bearish scenario, with all conditions inverted. Now, let us go to the chart, put everything together, and walk through how to identify the ICT Turtle Soup setup within the context of an internal liquidity sweep in a bullish scenario, step by step. On a bullish scenario, and within an internal range liquidity sweep context. First, start on a higher time frame, in this case, the 1 hour. In the bullish scenario, your focus is sell-side liquidity because that is where long stops tend to rest, below clear lows. Mark the most obvious levels, such as recent swing lows, previous day low, or previous week low. Then, once those liquidity areas are marked, wait for price to sweep that sell-side liquidity and close back above the level, returning inside the range. In many cases, this will appear as a candle that trades below the low and then closes back within the range, signaling a failed breakdown. However, in fast market conditions, this return can happen quickly and without much consolidation. After that, move down to your lower time frame, in this case the 5-minute. This is the time frame you will use for execution, not for prediction. Here you wait for a bullish market structure shift or a bullish change of character, meaning price starts to break above a key lower time frame swing high after the sweep, showing that bearish control is weakening. Here at ComLucro, we prefer to apply a Fibonacci retracement after the market structure shift occurs. Keep adjusting the retracement as price develops, and place a pending entry order at the 50% retracement level, targeting the nearest higher time frame buy-side liquidity. The same logic applies to the bearish scenario, with everything inverted. Now, the framework we just covered can be refined even further by incorporating fair value gaps into the execution process. Instead of relying only on the liquidity sweep and structural shift, we can use fair value gaps to identify more precise entry locations aligned with the underlying liquidity narrative. By combining market direction, liquidity manipulation, and imbalance-based execution, the setup evolves from a simple liquidity sweep into a more structured institutional framework. A high-probability bullish turtle soup setup occurs when price raids liquidity below a recent swing low while remaining positioned above a bullish fair value gap. In this case, the market sweeps sell-side liquidity, triggering stops from retail traders, but holds above a key demand imbalance. Similarly, a bearish turtle soup forms when price raids liquidity above a recent swing high while resting below a bearish fair value gap, signaling that buy-side liquidity has been collected before a potential move lower. Now, how do we approach execution? In this example, we clearly see an established uptrend, which means we are only interested in buying opportunities. The first reaction might be to place a buy limit directly at the visible demand zone. On the surface, this area appears to be a strong entry point. However, as smart money traders, we understand that this is exactly where many retail participants will enter long and place their stop losses just below the structure. This creates a strong probability of manipulation at that level, as the market often dips below the obvious demand zone to target sell-side liquidity before continuing higher. If you analyze the left side of the chart, you can also identify a bullish fair value gap that acts as a more refined demand zone. This imbalance provides a cleaner and more strategic location for entering a long position, aligned with liquidity logic rather than emotional entries. To properly trade the turtle soup setup, in a bullish scenario, we wait for price to sweep the liquidity below the swing low and then observe signs of rejection near the fair value gap. The key is patience. The liquidity raid below the low is designed to trigger sell-side stops and trap breakout sellers. Once price returns back inside the prior range after the raid, we can execute a buy position with our stop loss placed safely below the manipulated zone. From there, we target the next significant level ahead of price, typically a liquidity pool or structural high aligned with the prevailing trend. Now, in the bearish scenario, the same logic applies but in reverse. We wait for price to sweep liquidity above a recent swing high, and then watch for rejection near a bearish fair value gap. This move above the high often traps breakout buyers and collects buy-side liquidity. Once price drops back inside the prior range, we can open a sell position with our stop loss placed safely above the manipulated zone. The target then becomes the next important level below price, usually a sell-side liquidity pool or structural low aligned with the broader bearish direction. Now, let us explain the ICT turtle soup setup within the context of an external liquidity sweep in a bullish scenario. This setup appears when the market is already trending bullish and approaches an important external range high. Instead of continuing higher after the breakout, price sweeps external buy-side liquidity above the range extreme, triggers breakout traders and stop losses, and then quickly fails back below the level. In this context, the ICT turtle soup setup becomes a reversal entry rather than a continuation setup, as shown in the chart example. Here we are not looking for a random liquidity sweep. We are looking for a turtle soup condition forming at an external range extreme. This means price temporarily trades above a major high, takes the liquidity resting above the range, and then reclaims the previous structure after failing to sustain the breakout. The key idea is that the sweep itself is not the entry signal. The sweep only confirms that external liquidity resting above the highs has been taken. What matters next is whether price fails to continue higher after the sweep and starts showing signs of bearish reversal on the lower time frame, creating a bearish lower time frame change of character or market structure shift. After that, within our framework, we apply a Fibonacci retracement to the impulsive move and place a sell order at the 50% retracement level. The stop loss is placed above the structure high, while the targets are divided into two levels. The first target is positioned at a 1-to-1 risk-to-reward ratio, and the second target aims for the most recent lower low on the higher time frame. The same logic applies to the bearish scenario, with all conditions inverted. In an ICT turtle soup setup, within the context of an external liquidity sweep in a bullish scenario, the setup forms when a trending market temporarily fails after sweeping an important range extreme. First, start on a higher time frame, in this case the 1 hour, and identify a clear bullish structure with higher highs and higher lows. In this scenario, your focus is buy-side liquidity resting above the recent highs, where short stops and breakout entries tend to accumulate. Price often makes a shallow pullback, sometimes not even forming a clear higher low, and then pushes above the previous high. This move sweeps buy-side liquidity above the high, triggering stops and attracting late breakout buyers. Then, instead of continuing higher, price fails to hold above the high and starts to reverse, signaling that the breakout was false and that liquidity has been taken. After that, move down to your lower time frame, in this case, the 5-minute. This is the time frame you will use for execution, not for prediction. Here, you wait for a bearish market structure shift or a bearish change of character on the lower time frame. This occurs when price breaks below a key internal swing low after the sweep, showing that bullish control is weakening and that price is no longer accepting higher levels. Here, at ComLucro, we prefer to apply a Fibonacci retracement after the market structure shift occurs. Keep adjusting the retracement as price develops, and place a pending entry order at the 50% retracement level, targeting the nearest higher time frame sell-side liquidity. The same external range logic applies in a bearish market as well, with everything inverted. Now that we have studied turtle soup as a liquidity sweep model across internal and external ranges, let's move into a framework that applies the same liquidity logic inside the high and low of a single candle. So traders, what exactly is candle range theory? Candle range theory, or CRT, is a trading concept built around a simple idea. Every single candlestick represents a complete trading range defined by its high and its low. When you break that candle down into lower time frames, you will notice that its high and low often act as turning points. That is not random. Those levels mark where liquidity forms. In practice, those turning points become key liquidity levels because they represent the highest and lowest price traded during that period. That period could be a day, a week, or even a 1-minute candle. In other words, CRT is not about predicting random reversals. It is about understanding how price reacts to clearly defined liquidity boundaries inside a single candle. With that foundation, we can combine this structure with smart money concepts to build high probability opportunities. Now, in its classic form, CRT works with 3 candles, and each one has a specific role. The first candle defines the range. The second candle creates the sweep. The third candle provides the entry. Let's break that down step by step. Starting with the first candle, its high and low act as the primary liquidity levels that future price will often target. Since those levels represent the extremes of that trading period, they naturally attract orders and stop placements. For example, in a daily candle, the high and the low represent the absolute highest and lowest prices traded that day. That alone shows how significant those levels are. Even without analyzing lower time frames, we can identify important liquidity areas just by observing a single candle. The upper boundary is called the candle range high, or CRH. In smart money terms, the liquidity resting above this level is known as buy-side liquidity, or BSL, because it contains stop losses from short sellers and breakout buy orders. The lower boundary is called the candle range low, or CRL. In the same way, the liquidity resting below this level is referred to as sell-side liquidity, or SSL, since it includes stop losses from long positions and sell stop orders. This concept can be applied to any candle on any time frame. What matters is how price reacts to those boundaries. Now, when the second candle moves above the CRH and then quickly returns inside the range, that movement is called a liquidity sweep. In many cases, once liquidity is taken on one side, price will rotate toward the opposite side of the range. The same logic applies in reverse. If price sweeps below the CRL and closes back inside the range, it often seeks the liquidity resting near the candle range high. However, there is an important condition. If the second candle closes decisively above the CRH, the CRT setup becomes invalid. In that scenario, the market is expanding, not rejecting the range. But when the second candle fails to close above the candle range high and instead returns inside the range, we can then look to the third candle for a potential short setup, with the candle range low serving as the logical objective. That covers the core idea and the reasoning behind candle range theory. Now let's move to the concrete rules and break down how to trade it step by step on the chart. Now the first question to ask is, Which candle should you choose when applying the candle range theory? If you've explored this concept before, you've probably seen that one of the most common methods among traders is to focus on the 1-hour candle formed right before the New York session opens. Why? Because the New York session often produces strong reversals, especially shortly after the open. It typically begins by sweeping liquidity built up during the London session and then shifting direction. This behavior creates excellent trading opportunities. So here's a smart and structured approach. Apply the CRT model to the 1-hour candle immediately before the New York open. If price sweeps liquidity outside that candle's range and then re-enters it, you're seeing a setup that aligns with both CRT principles and the natural characteristics of the New York session. This confluence often produces high-probability setups, provided you time your entries accurately and manage risk properly. However, there's one limitation to this approach. It usually means trading against the prevailing trend. Trading in the direction of the trend gives more confidence and consistency in high-probability setups. So, is it possible to use CRT while staying aligned with the trend? The answer is yes. There's a refined version of this model that applies CRT logic within trending conditions. Let's break it down. First, identify a market that's clearly trending up or down. Then, wait for a corrective move, because corrections provide both better entry prices and safer stop-loss placement. For example, if the last impulsive move started from this point and pushed all the way up to here, we expect the correction to unfold within this range. From that point, we apply the CRT model only to bearish candles. Since the overall trend is bullish, we mark the high and low of each bearish candle and observe how the next candle reacts. If the next candle breaks below and closes outside the range, the setup becomes invalid and we move on. Then, we repeat the process with the next bearish candle. This continues until we find a candle that sweeps below its low but closes back inside its range. That's when we have a valid CRT setup. At that point, we've identified both the range and the sweep. Now, the next question is, where exactly do we enter the trade? A simple approach is to open a buy position immediately after the sweep candle closes. But there's a more refined and higher precision method. We can zoom into a lower time frame to locate a more accurate entry point. For example, if we're analyzing the 1-hour chart, we can drop down to the 5-minute or 15-minute chart to see what's really happening inside that move. On the lower time frame, more structural details become visible. In this strategy, we use the fair value gaps that appear right after the sweep as our entry zones. All we need to do is wait for a fair value gap to form following the sweep and then place a buy order within that zone. Our stop loss goes just below the gap. For trade management, we can make the position risk-free by taking partial profits when the trade reaches a 1-to-1 risk-to-reward ratio. This way, even if the market later reverses and hits the stop loss, we keep our capital protected. For the remaining portion, we let profits run until price reaches a major structure level ahead. Since this is a trend continuation setup, this combination of CRT logic and fair value gap entries offers a smart and efficient way to trade candle range theory. Now that we understand how liquidity can be framed through the range of a single candle, let's move into a more time-sensitive intraday model that combines liquidity sweeps, market structure shifts, and fair value gaps inside specific trading sessions. The ICT Silver Bullet. So, what is the ICT Silver Bullet strategy, and why do so many traders consider it a precise intraday framework? The Silver Bullet is an ICT trading strategy that combines three main concepts: market structure shift, liquidity sweep, and fair value gap. When these elements align within specific trading sessions, they create a structured opportunity based on liquidity and confirmation rather than random entries. To trade the Silver Bullet, wait for price to break above the day's high during the London or New York session, and then quickly return inside the range, taking out the buy-side liquidity. This movement above a key intraday level attracts breakout traders, but the fast return inside the range signals that liquidity has been collected. This liquidity sweep above the key structure of the day suggests that a potential reversal may be forming, especially when it occurs during high-volume session times. Next, we wait for a bearish market structure shift to confirm this potential reversal. A bearish market structure shift happens when price breaks and closes below the most recent swing low. This shift indicates that buyers are losing control and that selling pressure is beginning to dominate. In other words, demand is no longer in control, and price may start pushing to the downside with stronger momentum. Then mark the bearish fair value gaps that form during the displacement move as potential supply zones. These imbalances often act as retracement areas where institutions rebalance positions. Set a sell limit order at the beginning of the FVG zone and wait patiently for price to pull back into that area. If new fair value gaps form as price continues to move, you can map out future opportunities. But always follow a clear and disciplined risk management plan to protect your capital. Similarly, in the bullish scenario, the logic simply inverts. Wait for price to sweep liquidity below the day's low during the London or New York session. A valid liquidity sweep pattern forms when price breaks below a key level and then immediately returns back inside the range, signaling that sell-side liquidity has been taken. Next, wait for a bullish market structure shift to confirm that the reversal is valid. Finally, mark the fair value gap created during the displacement and plan your entry accordingly. If the fair value gap is relatively small, remember to use a slightly wider stop loss to give the trade enough breathing room and protect it from normal market fluctuations. In conclusion, the silver bullet strategy is powerful because it forces you to wait for liquidity to be taken, confirmation to appear, and imbalance to provide the entry. Instead of chasing breakouts, you trade the reaction after liquidity is cleared. When executed with patience and proper risk management, it becomes a structured and repeatable intraday model rather than a random setup. After understanding the silver bullet as a precise intraday framework, the next step is to expand that same logic across multiple time frames. Cameron's model keeps the focus on liquidity, timing, and fair value gaps, but adds a clearer process for identifying where price is likely trying to go before looking for the entry. Let us begin by understanding the foundation of Cameron's model and why it is considered such a powerful framework in liquidity-based trading. At first glance, the model appears remarkably simple. However, behind its simplicity lies a complete framework built around liquidity, market timing, multi-time frame analysis, and precision execution. Rather than relying on prediction, Cameron's model focuses on understanding where the market is likely to seek liquidity, when that liquidity is likely to be taken, and how to position yourself once that process unfolds. At its core, the model follows a clear three-step process. First, identify where liquidity is resting. Second, wait for that liquidity to be taken. And third, execute with precision using a structured entry model. This framework helps traders focus on market behavior rather than market prediction. So, in the first step of Cameron's model, you want to locate a key high or low on the 1-hour chart that price is approaching with intent. As shown in this example, we have a clear swing high on the hourly chart, and price is steadily drawing upward toward that level. We can reasonably anticipate price reaching this high because liquidity is resting there and the market seeks efficiency. If you cannot identify a clear draw on liquidity on the 1-hour chart, you can refine your perspective by zooming into the 15-minute chart to gain additional structure and clarity. However, identifying the liquidity target is only part of the process. We also want to understand whether multiple timeframes support the same trading idea. The next step is to identify a stop rate in the opposite direction of the draw on liquidity using the 5-minute chart for execution precision. So now, let us shift to a lower time frame. Keep in mind that in this example, the liquidity zone is positioned above current price. At this stage, we're looking for a swing low to be taken out, which is defined as a stop rate, meaning liquidity is being cleared before the anticipated move. Once that liquidity is removed, the final step is to look for fair value gap formations in order to set a buy limit with structure behind it. If you cannot find any fair value gaps on the 5-minute chart, you can zoom further into the 1-minute or even the 30-second chart to gain more precision and refine your entry. In a bearish scenario, the logic remains consistent and simply flips direction. First, identify a key liquidity zone that price is moving toward. Then switch to the 5-minute chart and wait patiently for a stop raid above a recent swing high. After that, locate a fair value gap and place a sell limit at the beginning of the FVG, positioning your stop loss just above it for protection. Always give price enough room to move naturally within structure, and avoid placing your stop loss too tight, as that can result in premature stop-outs and unnecessary losses. In summary, Cameron's model is powerful because it forces you to trade with structure, patience, and logic. Instead of guessing direction, you align with liquidity, wait for stops to be taken, and execute with confirmation. When applied consistently, this 3-step framework transforms trading from emotional decision-making into a disciplined and repeatable process. But confirmation does not always begin with a clear structural break. Sometimes the first clue appears in how price is delivered after liquidity has been taken. That is why the next concept is so important: change in state of delivery, or CISD. Most traders look for confirmation in structure, but the real shift in the market often happens before structure clearly breaks. If you understand how price transitions from control to execution, you can spot reversals earlier and enter with much better risk to reward. That is where the difference between change of character and change in state of delivery becomes critical. These two concepts explain not just where price breaks, but how momentum and control actually change behind the scenes. A change of character occurs when price begins to lose its previous structural control inside a broader swing. This process usually starts from a deeper pullback of the prior move, where price retraces 50% or even deeper of the swing. From this pullback, price develops a more complex movement, with both the expansion and the retracement containing several candles. This reflects a gradual transition phase, where control is weakening, but price delivery is still inefficient. The key role of the change of character is structure, not speed. It highlights that the prior directional bias is no longer dominant. A change in state of delivery focuses on how price is delivered rather than on structure itself. CISD typically appears after a liquidity sweep and is characterized by a sharp and efficient expansion, preceded by a short and shallow retracement, often around the 38.2% level. Both the expansion and the pullback usually involve very few candles. This reflects a sudden shift in momentum, where price moves with clear intent and efficiency. CISD signals that the market has transitioned from distribution or accumulation into active execution. In practical terms, CISD often appears before full structural confirmation. It provides an early indication that a reversal may be unfolding, especially when it occurs immediately after liquidity has been cleared from one side of the market. When combined with concepts such as liquidity sweeps and fair value gaps, CISD improves trade quality by aligning entries with momentum and institutional price delivery. Now let's get started. So what exactly is the change in the state of delivery? The change in the state of delivery, CISD, is a reversal pattern in which the price's momentum and delivery shift direction suddenly. In this example, you can observe a clear bullish trend. These 3 candles represent the most recent bullish delivery, showing strong and efficient momentum, which has pushed price above a recent structural level. This can also be referred to as the most recent buy-side delivery. Some traders mark the candle open as the CISD reference. In our approach, CISD is marked at the pullback extreme, just like change of character and break of structure, using the highest point in a bearish scenario and the lowest point in a bullish scenario. At this stage, the structure still appears bullish, and after a short-term correction, price would normally be expected to continue pushing upward. However, if price suddenly shifts behavior and delivers a strong bearish move, closing below the demand area and invalidating the prior bullish delivery, this condition is known as a change in the state of delivery. So what does this signify in terms of price action? First, it suggests that the breakout may have occurred to engage liquidity above this market structure level, rather than to sustain continuation. The buy-side delivery triggers buy-side liquidity, which can then be followed by a bearish shift in delivery. A break below the demand level shows that buyers are no longer supporting price with the same efficiency, while sellers have begun to deliver price more aggressively. This change in delivery signals a potential transition toward a bearish phase. So how can we use this concept to enter a trade? At this point, the short-term market bias begins to shift to bearish, meaning we prioritize sell opportunities while still monitoring structural confirmation. After observing a break and close below the origin point of the prior buy-side delivery, we recognize that this area may now act as resistance. While this does not by itself confirm a full structural reversal, it provides an important area of interest. When price pulls back into this zone and bearish delivery continues, it can present a high-quality opportunity to enter a short trade. Since this zone previously acted as support and is now showing resistance behavior, the probability of rejection and continuation to the downside increases. Entering a short position from this area allows participation in the emerging bearish momentum with a favorable risk to reward profile. It is important to remain patient and wait for price to return to this area before entering the trade. This patience improves execution quality, reduces risk, and increases the likelihood of capturing a sustained downward move rather than reacting impulsively. The same concept applies to the bearish scenario. However, it is important to note that not every change in state of delivery observed on the chart will lead to a successful trade, especially if it occurs without clear context, liquidity interaction, or directional relevance. CISD on its own only describes a change in delivery, not a guaranteed reversal. To trade CISD effectively, it must align with other market factors and conditions. Through backtesting, we've observed that CISD patterns are most effective when they appear within a well-defined market context. To qualify a high-quality CISD and prepare for a strong trade opportunity, certain conditions should be present. Let us now discuss the key factors that enhance the reliability of a CISD pattern. Rule number 1. Reaction at a higher time frame key level. As discussed earlier, CISD represents a shift in price delivery, and it becomes significantly more relevant when it occurs after price interacts with a higher time frame key zone. Key levels on higher time frames, such as the 4-hour, daily, or weekly, carry greater influence over price behavior. When price reaches these zones and a CISD forms, it suggests that delivery is shifting at an important area, increasing the probability of a meaningful move. Without higher time frame context, a CISD may still appear, but it's more likely to represent a short-lived fluctuation rather than a sustained transition. Rule number 2. Sweeping a liquidity pool. A high-quality CISD setup often occurs after the market sweeps liquidity from one side. Liquidity pools form around obvious equal highs and lows where traders place stop losses. When price sweeps these levels, it engages resting liquidity and creates the conditions for a potential shift in delivery. Once this liquidity is taken, price is more likely to transition into efficient movement in the opposite direction, making it an ideal environment for a CISD to appear. This does not confirm a reversal by itself, but it strongly increases the relevance of a CISD by showing that liquidity has been cleared and delivery conditions have changed. Rule number 3. Volume and confirmation. For a valid CISD setup, it is important to observe an increase in activity during the shift in price delivery. Higher participation reinforces the efficiency of the move and supports the change in momentum. Entering a trade based on CISD without this confirmation can be risky, as it may reflect a weak or short-lived change in delivery. This increase in activity is often visible through the formation of fair value gaps. Fair value gaps appear when price moves aggressively, creating imbalances that reflect strong directional intent. When a CISD forms alongside a fair value gap, it suggests that large participants are actively delivering price, adding credibility to the setup. A retracement into the fair value gap can offer a high probability area of interest, as price often revisits these imbalances before continuing in the direction of the new delivery. Combining CISD with fair value gaps improves timing and reduces execution risk. Rule number 4, waiting for the pullback to the reference level. After price breaks below or above the origin point of the prior delivery, it is important to wait for a retracement. This pullback allows traders to evaluate whether price accepts the new state of delivery. Rather than viewing this strictly as a structural flip from support to resistance or resistance to support, the focus should be on how price behaves when it revisits this area. Acceptance or rejection during the pullback helps confirm whether the new delivery is likely to continue. Entering on the pullback improves your risk-to-reward ratio and provides clearer information about whether the new state of delivery is being accepted. By following these rules, ensuring the CISD occurs at a key level, observing participation and delivery confirmation, and waiting for a retracement, you increase the chances of identifying high-quality trade setups with strong potential while controlling risk. Once we understand how delivery shifts and how confirmation begins to appear, the next question is where to enter without chasing price. This is where OTE becomes useful. OTE helps refine trade location by using Fibonacci, premium, discount, and optimal pricing inside the range. So traders, what is OTE in the ICT methodology, and how can it help identify higher probability trade entries? OTE stands for Optimal Trade Entry. It refers to a specific Fibonacci retracement zone that aligns with discount for long trade entries and with premium for short trade entries. The idea behind OTE is to refine entry timing by focusing on areas where price is considered optimally priced within a range. It is important to note that ICT's original teachings define the OTE using the 0.62, 0.705, and 0.79 retracement levels. However, at ComLucro, we prefer to use the traditional Fibonacci retracement levels of 0.618 and 0.786, while still recognizing the importance of the 0.702 midpoint. We believe that using the classical Fibonacci levels increases confluence, since these levels are widely followed by traders across different methodologies and markets. Before applying the OTE, it is important to correctly configure the Fibonacci retracement tool. In a bullish scenario, the 0 level should be placed at the swing high and the 1 level at the swing low. In a bearish scenario, the 0 level should be placed at the swing low and the 1 level at the swing high. Regardless of how the Fibonacci is drawn, the premium zone will always be located in the upper half of the range, while the discount zone will always be located in the lower half. The position of the Fibonacci levels may change, but the concepts of premium and discount remain the same. Let us now look at a practical example of how the OTE works on a real price chart. In this example, you can see the 4-hour chart of EURUSD. An important swing high and swing low have already been identified. From this range, we can mark out the discount and premium zones. Recall that a range is simply the distance between a swing high and a swing low. We can then plot the OTE for this same range. Notice how the OTE falls into the premium zone in this example. If price returns to this area, the focus is on observing how price reacts to each of the 3 levels that make up the OTE zone. As price moves forward, we can see a reaction at the 0.618 level of the OTE. While this level can be used as an entry, it is important to remember that the higher price trades into the premium zone, the greater the potential risk-reward ratio. In the next chart, price initially reacts slightly to the downside, then returns back into the OTE zone. Price closes above the midpoints but remains below the 0.786 level. On the very next candle, the market drops aggressively. Within one more candle, price reaches the swing low target. If a short trade was executed at the midpoint of the OTE, with a stop loss placed above the swing high and a target set at the swing low, this trade would have delivered a 2.4 risk-reward ratio. In the final image of this sequence, price continues moving lower after the initial target is reached. This highlights an important point. While a 2.4 risk-reward ratio is solid, there was additional downside potential that could have been captured depending on trade management. Let us now look at a long trade example using the OTE. In this case, price has just formed a swing high. We first draw the discount and premium zones, and then plot the OTE using the range defined on the chart. In the next chart, price returns into the OTE within the discount zone and reacts at the lowest level of the zone. Price touches this level without closing below it, and shortly after, price begins to move higher in the direction of the previous swing high, which represents buy-side liquidity. OTE helps us refine where price may offer a better entry inside premium or discount. But in some situations, we want even stronger confirmation, where market structure failure and imbalance overlap in the same area. That is where the Unicorn Model becomes useful. So what is the ICT Unicorn strategy? The ICT Unicorn is a trade entry strategy from ICT that focuses on high-quality setups formed by the overlap of a breaker block and an unmitigated fair value gap. This overlap marks areas where market structure fails and institutional imbalance creates strong price reactions. The concept is straightforward. A failed order block turns into a breaker block while a fair value gap forms in the same zone. When these align, they create a high confluence area where price often retraces before continuing or reversing with precision. The strategy is based on three core elements: market structure, breaker blocks, and fair value gaps. Together, they explain how liquidity events and failed order flow lead to repeatable high-probability trade entries. Let us start with the breaker block. A breaker block forms when a valid order block fails and flips into a new supply or demand zone on the chart. In basic price action, we already know this behavior well. When price breaks through support, that same level often acts as resistance later, simply because of how traders react to it. The same principle applies to order blocks. An order block can fail due to a shift in market structure and overextended price, or price tapping into an important higher time frame level. When a demand order block fails to hold and price breaks through it, that area flips into supply. This flipped zone is what we call a breaker block, and it becomes an area where we expect price to react and reject. Now let us talk about fair value gaps. Fair value gaps are also treated as supply or demand zones because they represent imbalance in the market. When a bearish fair value gap appears, it shows that selling pressure has clearly outweighed buying pressure, often driven by institutional activity. This creates market inefficiency, and price usually returns to that area to rebalance. When price revisits the fair value gap and there are still unfilled orders inside the zone, it creates an opportunity to trade in the direction of the existing momentum. That is when we often see price reject from the fair value gap and continue moving with strength in the same direction. It is important to keep one thing in mind. Fair value gaps must be unmitigated to remain valid. When a breaker block overlaps with an unmitigated fair value gap, this alignment creates a high-quality trading zone. When price returns to this area, the probability increases that it will behave as a strong supply zone and push price lower. In this situation, the entry is taken at the start of the zone, the stop loss is placed above it, and targets are set at the next key area ahead of price. The same logic applies in bullish scenarios, just in the opposite direction. Now let us look at a practical example using the euro-dollar on the 5-minute chart. We focus on the top of a recent impulsive move where a fair value gap has formed. The candle that created this gap can also be seen as an order block, marking a demand zone that would normally support price and push it higher. If price retraces into this zone, the expectation is usually a bullish rejection and continuation. But when price returns and breaks through the zone without holding, that demand area fails and flips its role. At that point, it becomes a breaker block. The bearish move that breaks below this former demand zone also creates a bearish fair value gap, signaling strong downside momentum. On their own, both the breaker block and the bearish fair value gap are meaningful areas. But when these two zones overlap, they create a high confluence trading zone. This overlap significantly increases the importance of the level and makes it a key area to watch for a strong market reaction. High confluence areas are zones where multiple price action signals come together, which naturally makes them more reliable. When different concepts align in the same area, more traders pay attention to that level. Because of this shared focus, these zones often trigger stronger and cleaner market reactions. That is why they become key areas where traders prepare, anticipate, and execute their trades. For the entry, the approach is straightforward. Place your sell limit order at the beginning of the high confluence zone and position your stop loss above the zone to protect against unexpected moves. When defining targets, aim for a healthy risk-to-reward ratio, such as 1:2 or 1:3, always based on the next important market structure levels ahead of price. To manage the trade more efficiently, one simple technique is to reduce risk once price reaches a 1-to-1 target. At that point, you can close half of the position and move the stop loss to break even. This way, even if price reverses and hits your stop, the trade does not result in a loss. At the same time, the remaining position is free to run in profit, allowing you to stay calm and focused while the market does the work. Another way to approach the entry is by waiting for price to return to the trading zone and then watching how it reacts. Instead of placing a limit order, you wait for a clear candlestick rejection, such as a long wick, showing strong rejection from the zone. This method is especially useful when the trading area is wide, as it allows you to refine the entry and achieve a better price. In this case, the stop loss is placed beyond the trading zone, and the same exit rules apply. By using both approaches, you create a balance between confirmation and reward, which helps you trade with more confidence. Now let us shift to a gold example on the 15-minute chart. The market is in a clear downtrend, and the most recent impulsive move has produced a well-defined fair value gap, signaling strong bearish momentum. Inside this retracement area, we can identify an order block that offers a potential entry zone for sellers. If price holds below this area, the bearish bias remains intact. However, if price breaks above it, that behavior can signal a shift in direction and the possibility of a reversal. Pay close attention to how price forms an overlapping fair value gap and breaker block in this area. This overlap creates a high confluence zone, which is exactly where we look for high probability reversal trades. The plan is simple. Enter at the start of the confluence zone. Place the stop loss just beyond it to protect against unexpected moves, and target the next key market structure levels ahead of price, always aiming for a favorable risk-to-reward ratio. This setup allows us to trade with more confidence because it is based on alignment, not guesswork. When multiple price action signals point to the same area, accuracy naturally improves. By following this structure, we increase the probability of catching quality reversal trades while keeping risk clearly defined and controlled. Since this entry can be part of a reversal strategy, it is important to highlight the role of multiple time frame analysis. Better results come from combining lower time frame entries with higher time frame context. This includes top-down analysis, understanding the broader market trend, and marking key supply and demand zones on higher time frames before looking for entries. For example, in the gold scenario, imagine price has reached a higher time frame demand zone. If the Unicorn Model forms inside this area, it creates strong confirmation. The higher time frame context supports the trade, while the lower time frame provides precision for execution. Even if the lower time frame shows short-term bearish momentum, the higher time frame structure may still be bullish. In that case, a long entry aligns with the dominant trend, which greatly increases the probability of reaching the intended targets. So, trader, if this video helped you gain more clarity, Make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader Community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.